the next piece. One piece we talked about is the financial analytics, the financial learning how to use the model. And now the only reason you really like, I want you to learn how to use the model is so that you can challenge Zach's growth estimate of 19%, right? Because in a way, why would Warren Buffett buy a company in a way? Is because he believes, listen, the company is worth a third of what it's really worth. How do you know a company is worth a third of what it's worth? Okay, so if you looked at the model in more detail, if you notice that the true growth rate is really 25% and not 19%, then you crunch the numbers, go through the numbers, and you see the valuation of the company is really 100 billion and not 50 billion. So the company is undervalued by 50%. Now, if you're gonna value that and speculate on that, what is the key number one driver that you have to be sure of? It's the growth rate. It's the growth rate. The growth rate that you said was 25 instead of 19 is the reason you determine a valuation of 100 billion instead of 50 billion. And that depends, now getting deeper into actual financial statement detail. Now it's like, hey, how do you get this growth rate of 25%? Why are you getting that? So on an economic level, see here, we are encouraged by Canadian Pacific's healthy performance backed by volume addition, safety and efficiency along with cost metrics. Additionally, pricing above inflationary levels is expected to aid the company's projected revenue growth of 6 to 7% in 2014. Further, Canadian Pacific remains committed to generating an operating ratio in the low 70s. Canadian Pacific also targets an operating ratio of 65% in 2014, way ahead of its initial target of 2016. To attain this, the company focused on upgrading its network capabilities by consolidating repairing facilities that will enable it to operate longer and heavier trains, achieve higher car velocity, as well as deliver on-time performance. So what are we getting here? We're seeing here the revenue growth is projected to be 6 to 7% in 2014. So it's the revenue growth of 6 to 7% that's creating the leverage to create a 19% growth in earnings. So how the earnings get impacted primarily by the quantity of revenue and the degree of revenue that trickles down to income. That's this piece, the operating ratio. So they're saying that they're improving their operating ratio to 65% a year in advance, in a way saying, hey, we're keeping more dollars in income compared to before. It's another way to create growth in EPS. So growth in EPS really comes from revenue increase, which is organic pure growth, and operating ratio increase due to internal innovation and efficiency, which is upgrading its network. And that comes in the form of creating more efficient conversion of revenue into earnings. So the question we need to answer is listen, is that 19% available to us, or is it really 15 or 25 based on looking at revenue and streamlining it through the profit margin, operating margin here, operating ratio, and seeing what is the actual EPS flow through to get this here. So this is something that we're looking at, and we don't have to get it exact on this one. We'll have 2 more tries in terms of putting all these together. But from a fundamental way, what is the true situation here? Why has this company become so popular? Why is it trading so high? I think one of the reasons is that a long term, over the next 30, 40, 50, 100 years, they will be very successful because coal demand continues to be a significant driver and contributor for transportation. So the idea is that more and more coal is in demand for energy. Electric power comes from burning coal. So more and more coal plants are coming on. More and more power companies are buying coal. So long term, we're demanding more power. Thus, we're demanding more coal. Thus, coal transportation is in effect growing. So this is contributing to long steady, secure growth that is really contributing to the growth of this company and to the growth of its market cap. So it's in a way, how confident are you that this is growing, and how can you quantify it? Maybe you can look at the report of the amount of coal demand in the US and see, listen, the coal demand is going to double in 20 years, right? And CP has like half the market, so that's going to increase its revenue basically by double, which is not far from the truth, because 7% growth a year for 20 years is going to probably double in 20 years. So that's the kind of growth, consistent, long-term growth we're talking about from a strategic, being the only company that can really transport coal coast to coast and having the situation where they're in right now. So I want you guys to look at that economics and, focus on that so that you can work on your project. And I'm looking forward to seeing you guys on Wednesday. I'm looking forward to meeting you guys and seeing the research. And I'll see you guys and meet you guys Wednesday night at the presentation.